Ever heard the term reverse flipping? You must have heard about it a lot considering so many startups following this trend. But what does it actually mean? It means shifting the base of an Indian company back to India after it moved overseas for its headquarters. Now you must be wondering what the need is for doing so if the NRI is well settled there. Well, there are multiple reasons for it. The recent tweak in Rule 25A of the CAA rules came as a welcoming amendment from the Ministry of Corporate Affairs about the foreign startup merger into its wholly owned Indian subsidiary. If a company is based abroad, how will it reap the domestic benefits that the Indian government offers? What benefits? India offers a plethora of benefits for Indian startups, be it tax incentives, Make in India initiatives, or foreign investment relaxations. Enticing enough? There is more. The future plan of every startup is to get its company listed on Indian stock exchanges. But foreign companies often have to take a different route to get it done. Most importantly, investor trust in the Indian startup world is on another level. So, the funding part is much more simplified and lucrative in India. All in all, the transformation of ease of doing business in India has been significantly positive, especially in the past decade. But do you think these reasons are big enough to come back to India? Well, a big yes. Let's understand the term with a famous real business world example. PhonePe, one of the pioneers of this entire reverse flipping trend, moved its base from Singapore to India in 2022. It was one of the most significant years for the company in terms of tax paying. So, the whole story began with the acquisition of PhonePe by Flipkart, which is owned by Walmart. The entire structure of PhonePe went to Singapore. In 2020, the ownership of PhonePe was transferred to Walmart after the major split of PhonePe and Flipkart. After so much happening with it, in 2022, PhonePe decided to pack its bags and come back to India. Why? Because it wanted to put all its focus on the Indian market, and also the plan to go all public was on the card. The company also believed that by moving back to India, it could cater to the needs of the customers more seamlessly. The company started with a comprehensive three-step process that began with shifting its businesses and other subsidiaries of PhonePe Singapore to PhonePe Private Limited and swapping its shares with all the shareholders. Also, the company had to create a completely new ESOP plan with the Indian guide and migrated over 3,000 employees to the newly made plan. Again, why? Because that's the price you pay to enjoy Indian benefits. Also, shifting the domicile to India is treated as a capital gain event. Having so much done, there were multiple consequences of the migration. PhonePe lost the chance of offsetting its $900 million loss against future profits, all because of the provisions in Section 79 of the Income Tax Act, which restricts domiciling of Singapore to India. A notable fact is that PhonePe dominates the digital payments market of India with a huge chunk of over 48% by volume and 50% by value. So, the whole transition from Singapore to India has been worth it. All the leading startups, including Zepto, Pine Labs, Razorpay, Groww, Pepperfry, and many more, are either on the lookout for reverse flipping or have completed the process. Because it's the new and lucrative trend in the business ecosystem. Undoubtedly, the benefits of reverse flipping are undeniable, and the Indian government is all out there promoting it, but it is also stern on the tax implications and procedures of startups switching base. Not to forget, there is a price tag attached to everything flowery.